Hello everyone, I'm Joey, and welcome back. If you've gone grocery shopping recently, filled up your gas tank, or looked at the price of a new home, you've probably asked yourself the same question millions of Americans are asking right now. Why does everything seem to be getting expensive again? Just a few months ago, many experts believed inflation was finally moving closer to normal levels. But now, new economic reports suggest that price pressures are building once again. The Federal Reserve recently noted that inflation has picked up, pointing to several key factors, including higher import tariffs, rising energy costs linked to tensions in the Middle East, and the enormous wave of investment in artificial intelligence infrastructure. That doesn't automatically mean we're heading back to the inflation crisis we experienced a few years ago, but it does raise some important questions. Could prices continue climbing? Will interest rates stay high? How will this affect your mortgage, your savings, your paycheck, and your everyday life? Today, we're going to break it all down in simple terms. No confusing economic language, no political opinions, just a clear explanation of what's happening, why it's happening, and what it could mean for you over the next several months. Let's begin. Inflation affects more than just prices. When most people hear the word inflation, they immediately think about paying more at the grocery store, and that's certainly part of it. But inflation reaches much further than that. It influences almost every financial decision people make. The cost of buying a car, the interest on a mortgage, the price of renting an apartment, credit card payments, insurance premiums, business investments, even retirement savings. Here's a simple example. Imagine you received a 4% raise this year. At first, that sounds like good news. But if the overall cost of living rises by 5%, your purchasing power actually goes down. Even though your paycheck is larger, it buys less than it did before. That's why inflation matters so much. It quietly reduces the value of your money, and over time, those small increases begin adding up. A few extra dollars at the supermarket, higher utility bills, more expensive insurance, more expensive travel. Eventually, families begin adjusting their budgets without even realizing it. Why are prices starting to rise again? One of the biggest misconceptions is that inflation happens because of one single event. In reality, it's usually the result of several different forces happening at the same time. According to the Federal Reserve's latest economic assessment, three major factors are currently putting upward pressure on prices. Let's examine each one. Reason number one: higher import tariffs. A tariff is essentially a tax placed on imported goods. When companies pay more to bring products into the country, those additional costs often don't disappear. Businesses frequently pass at least part of those costs on to consumers. Think about products many families buy every week: electronics, kitchen appliances, furniture, clothing, home improvement supplies, even certain food products. If the cost of importing those goods increases, retail prices often follow. Now imagine this happening across thousands of products. The impact may not be dramatic overnight, but over time, consumers begin noticing that many everyday items cost a little more than they did before. That's one reason economists continue watching tariff policies very closely. Reason number two: rising energy costs. Energy is one of the most important pieces of the entire economy. When people hear energy prices, most immediately think about gasoline. But gasoline is only part of the story. Fuel powers cargo ships, delivery trucks, factories, construction equipment, farm machinery, airlines, public transportation. Nearly every product you buy depends on transportation somewhere along the supply chain. When oil prices increase, shipping becomes more expensive. Manufacturing costs rise. Businesses spend more operating their facilities. Eventually, those higher operating costs often appear in the prices consumers pay. Recent geopolitical tensions in the Middle East have increased uncertainty in global energy markets, making businesses more cautious and contributing to inflation concerns. Even relatively small increases in oil prices can ripple throughout the economy because energy affects almost every industry. Reason number three: the artificial intelligence investment boom. This may be the most surprising factor. Artificial intelligence is transforming entire industries. Companies are investing hundreds of billions of dollars into AI. They're building enormous data centers, buying advanced computer chips, expanding cloud infrastructure, hiring highly specialized engineers, and consuming record amounts of electricity. All of that creates massive demand. Whenever demand grows faster than supply, prices tend to move higher. For example, the demand for advanced semiconductor chips has exploded. Building new factories takes years. Expanding power grids takes years. Training highly skilled workers takes years. In the short term, limited supply combined with extraordinary demand naturally places upward pressure on prices. Many economists believe that while AI may eventually improve productivity and lower costs over the long run, the current investment boom is contributing to inflation in several sectors today. Is this the same inflation we saw after the pandemic? Not exactly. The inflation surge after COVID-19 was driven by a unique combination of supply chain disruptions, massive government stimulus, labor shortages, and unusually strong consumer demand. Today's situation is different. Supply chains have largely recovered. Many industries are operating normally again. However, new inflationary pressures have emerged. Trade policies, energy markets, large-scale technology investments, global uncertainty. Instead of one major cause, we're seeing several moderate forces working together. And that's what makes today's economic environment so challenging. Why the Federal Reserve is watching so closely. The Federal Reserve has a long-term inflation target of around 2%. That level is generally considered consistent with stable economic growth. When inflation remains significantly above that target, the Fed has to decide whether interest rates should remain high for longer. Higher interest rates help slow inflation because borrowing becomes more expensive. People spend less. Businesses invest more carefully. Demand cools down. Eventually, price increases may begin slowing. But there's a trade-off. If interest rates remain elevated for too long, economic growth can slow. Hiring may weaken. Home affordability may remain difficult. Businesses may delay expansion. Finding the right balance is incredibly difficult. Raise rates too much, and the economy could slow sharply. Lower them too soon, and inflation could accelerate again. That's exactly the challenge policymakers are facing today. So, what happens next? Could grocery prices continue climbing? Will mortgage rates stay high throughout the rest of the year? Which everyday products are most likely to become more expensive? And most importantly, how can ordinary families prepare without making costly financial mistakes? So, what happens next? Could grocery prices continue climbing? Will mortgage rates stay high throughout the rest of the year? Which everyday products are most likely to become more expensive? And most importantly, how can ordinary families prepare without making costly financial mistakes? Let's continue. What could become more expensive? When inflation starts building, not every product rises in price at the same speed. Some categories tend to react much faster than others. One of the first is food. If transportation costs increase, farmers, food manufacturers, and grocery stores all pay more to move products across the country. Those added costs often reach consumers. Another major category is energy. Gasoline, electricity, and natural gas influence household budgets directly, but they also affect the cost of producing and delivering almost everything else. Housing is another area many families continue to struggle with. Even if home prices stabilize, higher mortgage rates can make monthly payments much more expensive, reducing affordability for first-time buyers. Insurance premiums have also increased in many parts of the country, adding another expense that many families didn't face a few years ago. When several everyday costs rise together, households often begin cutting back on discretionary spending. That's one reason economists closely monitor consumer confidence during periods of rising inflation. What about interest rates? One of the biggest questions investors and everyday Americans are asking is whether the Federal Reserve will lower interest rates soon. The answer depends largely on inflation. If inflation continues moving higher, the Fed may decide to keep rates elevated until there's stronger evidence that price pressures are easing. That affects much more than Wall Street. Higher interest rates usually mean more expensive mortgages, higher monthly car payments, increased credit card interest, more expensive business loans. At the same time, higher rates can also benefit savers because many savings accounts and certificates of deposit offer better returns than they did just a few years ago. In other words, higher interest rates create both winners and losers. It all depends on whether you're borrowing money or saving it. Could this lead to a recession? Whenever inflation rises, people immediately start worrying about another recession. But inflation does not automatically lead to an economic downturn. The U.S. economy is influenced by many factors, including consumer spending, business investment, employment, productivity, and global events. Right now, the labor market has remained relatively resilient, with unemployment still low by historical standards. However, economists continue watching closely because if inflation remains stubbornly high for too long, it could slow economic activity as consumers and businesses become more cautious. The key point is this: no one knows exactly what will happen next. Economic forecasts are based on probabilities, not certainties. That's why it's important to avoid making financial decisions based on fear or sensational headlines. How can families protect their finances? While none of us can control inflation, we can control how we respond to it. The first step is understanding where your money goes every month. Review your spending. Identify subscriptions or recurring expenses you no longer use. Build an emergency fund if possible. Even a few months of savings can provide peace of mind during uncertain times. If you have high-interest credit card debt, paying it down may become even more valuable while borrowing costs remain elevated. For long-term investors, remember that markets naturally go through periods of uncertainty. History has shown that reacting emotionally to short-term headlines often leads to poor financial decisions. Instead, many financial professionals encourage focusing on long-term goals rather than daily market movements. Why this matters to everyone. Some people think inflation only matters to economists or investors, but that's simply not true. Inflation affects every paycheck, every grocery trip, every family budget, every retirement plan. Even small increases in prices become significant over time because they affect items we buy every week. That's why understanding inflation is one of the most valuable financial skills anyone can develop. The more you understand what's happening, the better prepared you'll be to make informed decisions for yourself and your family. Final thoughts. The recent rise in inflation doesn't necessarily mean we're returning to the economic conditions seen a few years ago. But it does remind us that inflation hasn't completely disappeared. The economy is constantly changing. Trade policies evolve. Energy markets shift. Technology creates new opportunities and new challenges. The Federal Reserve will continue monitoring incoming economic data before making future decisions on interest rates. Until then, staying informed is one of the smartest things you can do. Understanding the forces shaping the economy won't eliminate inflation, but it can help you make better financial choices and avoid unnecessary panic. If you found this explanation helpful, subscribe for more clear, fact-based videos about the economy, personal finance, investing, and the biggest stories affecting your money. I'm Joey. Thanks for watching, and I'll see you in the next video.